Hi, my name is Daniel Jurgen. I'm a financial planner at Valmark Financial Group, and today we're going to be talking about qualified charitable distributions, or QCDs for short. Now, the basics of a QCD is that you take a distribution from your IRA and you donate it to a charity of your choice, and that distribution is excluded in your taxable income for the year. So there's quite a few benefits when you pair the benefits of IRAs with QCDs. There's a potential tax deduction when you make the contribution to the IRA. You get the tax deferral on the growth of that contribution, and then the distribution could be tax-free if you're doing a QCD. Let's talk about some of the pros and cons of QCDs. Starting with the benefits, QCDs are actually not included in your taxable income for the year. Going one step further, you actually don't need to itemize your deductions in order to receive a benefit from the QCD. QCDs allow you to still claim the standard deduction and receive the full benefit of the QCD. And this is because QCDs do not increase your AGI and then reduce your taxable income. QCDs just simply aren't reported anywhere on your 1040, which is great for taxpayers looking to keep their AGI low enough to avoid certain stealth taxes or qualify for certain tax deductions or tax credits. And lastly, QCDs satisfy RMDs, or required minimum distributions, dollar for dollar. So if you have a $20,000 RMD, but you're not looking to increase your AGI by $20,000, you could in turn do a QCD for $20,000, not increasing your AGI whatsoever and satisfying your RMD for the year. Let's switch to some of the drawbacks of QCDs. First, QCDs aren't eligible to be done until an individual reaches age 70 and a half. And that's not even the year that they turn 70 and a half. That's quite literally 6 months after their 70th birthday. There's also a dollar limit, which is currently $100,000 per spouse. And that's not to say that one spouse could do a $200,000 QCD on behalf of both spouses. Each spouse would have to do a $100,000 QCD from their own IRA. The donation must also come directly from your IRA, so you're not eligible to make a charitable gift and then later reimburse yourself from your IRA. Qualified plans also aren't eligible for QCDs. So if you have money in a 401k that you would like to give to charity via QCD, you would first have to roll that money into an IRA. There's also the RMDs out first rule to keep in mind, which states that every dollar that comes out of your IRA beginning in January of the year you turn 72 is deemed to have satisfied your RMDs. This is important to know for taxpayers looking to use QCDs as a way to satisfy their RMDs. You would first want to do the QCD and then do any remaining RMDs that you have for the tax year. And lastly, private foundations and donor advised funds are not eligible to receive QCDs. However, you could always name a donor advised fund as a beneficiary of your IRA and leave it to them after your death. You just simply can't give to a donor advised fund via QCD during your lifetime. Now that we talked about some of the benefits and some of the drawbacks of QCDs, let's talk about the steps in terms of how to make one. So there's actually two options. Option A is having the custodian write the check for you, and option B is you writing the check. Assuming we go with option A, you would simply contact your custodian, ask them to write a check to the charity of your choice, which they would then write and mail the check to the charity, and then within a few business days, you would see the QCD deducted from your IRA. Alternatively, option B, you can contact your custodian, asking them for check writing privileges on your IRA. You would then write and mail the check to the charity, and then whenever the charity gets around to cashing the check, that's when the QCD would be deducted from your IRA. Now, at face value, both of these options might seem very similar, but there is one difference that I'd like to point out, and that is the year in which the QCD is deemed to have been made. Current tax law states that QCDs are deemed to have been made in the tax year that they're deducted from your accounts. So if it's already mid to late December, option A would ensure that the QCD would be done in the tax year that you intend. Alternatively, option B, there might be a delay due to mailing issues, or if the charity is closed for the holidays, and it might not be until the following January that they get around to cashing the check, which could blow up the entire QCD strategy. So I hope you learned a little bit about QCDs, some of their benefits and drawbacks, and the steps in how to complete one. Thank you very much.